Unity Software's growth segment jumped 35% year over year on the back of their AI ads platform, and the guidance says it's about to accelerate to 44% next quarter. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Unity Software gets graded and traded. So on the headline, revenue came in 6.39% ahead of estimates, and the underlying growth is even better. Total revenue was up 24% year over year, and the strategic revenue that actually matters going forward was up 38%. And on EPS, they beat by 27%. That's a clean beat on both lines, and it's backed by real operational strength. Adjusted EBITDA nearly doubled. So on the beat itself, this earns a B. A 6% revenue beat paired with a 27% EPS beat is solidly above the line, just not the kind of blowout that pushes you into A territory. And on consistency, this earns an A. Unity has been stacking beats quarter after quarter, and this print just extends that track record. Let's talk about the positives from the report. Strategic revenue, which is the core go-forward business, was up 38% year over year to $486 million. That's the number I care about because it strips out the legacy at business they're intentionally winding down. This is a real growth rate, not a reporting artifact. The engine behind that growth is the Grow Solutions segment, which was up 35% year over year to $389 million. And this is being driven by Unity Vector, which is their AI-powered ads platform. This segment is not decelerating, it's actually accelerating. Adjusted EBITDA nearly doubled to $160 million, and the margin went from 21% last year to 29% this quarter. That's an 8 percentage point margin expansion year over year, which is a huge move. Both the top line and the cost discipline are firing at the same time. Free cash flow came in at $202 million, up 59% from last year, and cash on the balance sheet grew by $293 million year to date to $2.36 billion. So they've got real dry powder here. And this is the piece that really matters. The third quarter guidance calls for strategic revenue between $540 and $550 million. That's 44 to 47% year over year growth, which is an acceleration from the 38% they just did. Management is guiding to the story getting stronger, not weaker. So on profitability, this earns an A. Doubling adjusted EBITDA, expanding margins by 800 basis points, and putting up 60% free cash flow growth all in the same quarter is about as clean a profitability story as you get. Now, let's talk about the negatives from the report. GAAP net loss was still $23 million for the quarter and $370 million year to date. A lot of that year to date number is a $271 million impairment charge, so it's noisy. But the fact is the reported bottom line is still in the red. The Create Solutions side, which is the subscription and engine business, only grew 5% year over year to $157 million, and they're guiding it to just 7 to 10% next quarter. So the subscription piece is basically flat while Grow does all the heavy lifting. Research and development expense grew 30% year over year to $278 million, and it now eats up 51% of revenue on a GAAP basis. Some of that is amortization from acquisitions, but the raw spend growth is running way ahead of Create Solutions growth. $557 million of convertible notes are now current, meaning due within 12 months, and there's another $1.68 billion in long-term convertibles behind that. Cash covers this comfortably today, but refinancing and potential dilution are live variables to keep an eye on. And restructuring costs jumped to $31 million this quarter from $11 million a year ago. So the cost-cutting story isn't finished. The underlying cost base is still being reshaped rather than sitting stable. On guidance, this lands at an A-. They actually gave real numbers for next quarter, and those numbers imply strategic revenue accelerating to 44 to 47% year over year, and EBITDA up 69 to 74%. That's a real raise into the back half. And on red flags, I'm at a C+. The convertible debt stack, the still negative GAAP earnings, and the fact that research and development is eating half of revenue are all real concerns. But nothing here is a broken thesis. It's just risk you have to size around. Putting it all together, this is what management called arguably the best quarter in Unity's history as a public company, and the numbers back that up. The strategic revenue growth, the doubling of adjusted EBITDA, and the guided acceleration into the third quarter all point to the Unity Vector story being a genuine platform inflection rather than a one-quarter pop. The GAAP loss and the convertible debt stack keep this from being a low-risk compounder, but the operational trajectory is undeniably strong. I'm giving this print a B+. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. I'm not rushing in right at the open on this one. The implied volatility crush usually takes a day or two to fully work through, and selling puts into that collapse just gets me front run by the drop in premium. Management guided third quarter strategic revenue to accelerate to 44 to 47% growth. So any dip I see over the next 2 weeks, I'm treating as an entry opportunity, not a warning sign. That said, I'm keeping my first entry small. GAAP net income is still negative, and there's a $2.2 billion convertible stack sitting on the balance sheet, so I don't want to be oversized on day one. So my play here is simple. I wait out the IV crush before I sell my first put. The guided third quarter adjusted EBITDA of $185 to $190 million gives me a fundamental floor to anchor my strike selection against. For my first cycle after earnings, I'm assuming third quarter comes in at the low end of guidance, not the high end. GAAP risk cuts both ways after a company just guided to acceleration, so I want cushion. And I'm only picking a strike ceiling as aggressive as a level I would genuinely be happy owning the shares at. If I wouldn't want assignment there, I don't sell the put there. Bottom line for my cash secured puts, I'm staying well out of the money this first cycle. The print validated the Unity Vector story that shareholders have been waiting on, so I'm not looking to trim my shares off this report. Management guided to sequential acceleration into the third quarter, which is the exact opposite of what a fading growth story looks like. That's a green flag to me. If shares get hit because of the GAAP net loss headline, that's mostly restructuring and amortization noise. I'd treat weakness there as an add spot rather than an exit signal. The only thing that changes my stance is if the November print fails to deliver the acceleration. So on my shares, I'm holding with conviction. The guided acceleration into next quarter tells me not to sell aggressive near-the-money calls on my next cycle. The setup for a grind higher is stronger after this print than it was going in. If my calls are now in the money after a post-earnings pop, I'm rolling them up and out. That captures more premium and gives my shares more room to run into the third quarter catalyst. For any deep out-of-the-money calls I've already got sitting out there, I'm just letting those ride toward expiration and collecting the premium. So my move on covered calls that got tagged, I roll up and out on the in-the-money ones. The Vector platform inflection got substantial validation this quarter, and that's the whole reason I own long-dated calls on this name in the first place. 35% growth in the grow segment with management guiding to further acceleration is exactly the setup my leaps were paying for. Taking profits here feels premature to me when guided third quarter EBITDA alone implies serious full-year cash generation. The one structural risk I keep in mind is the $2.2 billion convertible debt stack. That caps how large any single leaps position of mine gets to be. So on my leaps, I'm holding or adding on weakness. If I'm underwater here, the print actually validates the underlying thesis for me. Strategic revenue is accelerating to a guided 44 to 47% year over year, and adjusted EBITDA margins expanded 800 percentage points worth in the right direction. Free cash flow was up 59% year over year on top of that. Those are all signs the operational story is intact and not deteriorating, so averaging down into post-print weakness is defensible for me. What I would not do is keep averaging down if the November third quarter print fails to deliver on the guided acceleration. That would be my signal to reconsider the position rather than double down again. So my rule for adding here, I add on weakness, not on failure. Bottom line, this print earns a B+ from me. The Vector platform got real validation this quarter, and management guided to the story getting stronger, not weaker. Just size around the convertible debt and the still negative gap line. Thanks for watching, and I'll see you on the next one.